Hello, Eddie Ardeni here. It's Sunday, September 25th. I'm pre-recording this webinar of ours, so there won't be a Q&A. That give me a little bit more time to run into some of the issues that have been piling up here in the financial markets. I hope you all had a good weekend. I kind of doubt that you had a good week last week unless you were short stocks and short bonds. It was a real bad week for both markets. It actually started out quite bad early on in the week on actually the Friday a week ago, because what happened is Thursday evening, FedEx came out and reported some very disappointing earnings and some commentary that indicated that business was weak on a worldwide basis, including in the United States. So the financial markets immediately interpret that as confirming that the US economy is weak, maybe even falling into a recession. And so that had a negative impact on the stock market a week ago, Friday. And then we came in on Monday, Tuesday, Wednesday, market remained on the defensive. But then Wednesday in the afternoon, Fed Chair Powell presented his press conference following the FOMC meeting. No one was surprised by the fact that the Fed raised the Fed funds rate by 75 basis points. I thought they should go by 100, but they just won't listen to me. But they did 75 basis points. But then the summary of economic projections was revised to show a more hawkish outlook for the Fed funds rate going into next year, and a higher inflation rate than they had previously estimated. And then Powell just kind of piled in with a continuation of this new pitch that he started at Jackson Hole at the end of August. And the idea is that he's pivoted again. He pivoted back in 2020, in the summer of 2020. He pivoted and made the Fed's dual mandate, gave unemployment a higher priority than inflation. And inflation, he said that they were going to go for a flexible inflation target, which meant that they would be willing to overshoot 2% for a while since they'd undershot it for so long. Beware of what you wish for, because it was 6 months later that inflation shot up above 2%. That was March 2021, and it just didn't look back, and we just kept going up and up on the inflation front. I think that inflation actually did peak in the first half of the year, but the markets are concerned that it remains, the jury's basically out on whether that's in fact the case. And I admit that. But what really matters is what the Fed says, and what Fed Chair Powell said is that inflation is a big problem, and that contrary to what he suggested at the end of last year, particularly earlier this year, that they might raise interest rates and pause, he said they're not going to pause. They're just going to keep raising interest rates until they're convinced that inflation's coming down. In the July meeting, he did again say that the Fed, he said that he viewed 2.25% to 2.5%, which is what the Fed funds rate was raised to at the time. He said that he kind of viewed that as being back at neutral. So the markets actually rallied on his late July commentary. And I guess that got him concerned that the market was not reading him right. And so he came back with a Jackson Hole speech at the end of August, in which he made it pretty clear that the Fed was going to be raising interest rates, and that they hadn't really gotten restrictive enough yet. And sure enough, at this meeting last Wednesday, when they raised it by 75 basis points again, he made it clear that he thought that the latest range was at the low end of restrictive. So raising the alarms that they had more to do, and that they were going to keep rates higher for longer. I never really got the idea of, got where the idea came from that they were going to actually ease next year. but apparently that was kind of the explanation for why the stocks and bonds were doing so well following the July meeting. And so he felt he had to kind of be very assertive on what he actually intended, what he actually means. Now, again, he's the pivoter, and he's quite possibly quite likely to pivot again. But if the next pivot occurs, it's more likely to be towards the dovish side than the hawkish side. And I think the Fed made a mistake back in 2020, being too giving more weight to keeping unemployment down than keeping inflation down. I think that was a big mistake. So since the pandemic, that was big mistake number one. And I think big mistake number two was basically made last week on Wednesday when he came across as being ultra hawkish, pounding the table on the Fed needing to raise interest rates a lot to bring inflation down, and was that the Fed wasn't even going to bother pausing to see how these 75, 3 hikes in a row, what impact they're having on the economy and on inflation. I think inflation is moderating. I think we're going to see it down to 4 to 5% in the second half of the year. I think the Fed is increasing the odds of a recession. I'm still in the growth recession camp, which means that we've had no growth really in the first half of the year, and we probably won't have any growth in the second half of the year. But of course, there's lots of others that listened to Powell and concluded that the Fed's going to drive us into a recession. In some ways, that's understandable. In a lot of ways, it's understandable because Powell made it pretty clear that he was channeling Volcker, and he mentioned Volcker as sort of someone that had done a great job of bringing inflation down, but we all know it came with a very severe recession. He kept using the phrase, by the way, on Wednesday, keep at it. And Paul Volcker's autobiography, I think it came out in 2018, is called Keeping at It. So I guess on his night table, Powell's been reading Volcker's autobiography as sort of a guidebook for what he needs to do. And so he's coming across very, very, very tough on inflation. But look, the Fed's already been extremely restrictive in many, many areas. Sure, they've been a little late in raising interest rates, but their rhetoric, their guidance has been so hawkish that the fixed income markets have already figured it out. And we've seen most recently the 2-year over 4%. We've seen the 10-year go up to 3.7%. But even before that, we were getting to levels that indicated that the fixed income markets were anticipating that the Fed was going to turn tougher. So we've had a restrictive monetary policy. And that's especially true when we look at the housing market. The housing market is in a recession, and now it's Powell's pushing it even deeper into recession. Look, there's a lot of people who bought houses over the years and did it with record low mortgage rates. They have no incentive to trade up or down and deal with mortgage rates now at 6.5%, 7%. And then, of course, new home buyers, the affordability problem is huge for them, and they're not going to jump in and buy unless prices are cut pretty substantially. So there's likely to be some significant deflation in home prices. I don't think this is going to get us the great financial crisis all over again, but it does have recessionary repercussions. The housing market has been in a recession. We know that second quarter, it was a major contributor to the weak GDP data. Turned out, by the way, that it wasn't so much because of construction, it was because of real estate commission fees. Obviously, with a drop in existing home sales, that had an impact on fees paid to real estate agents. So there's still weakness ahead, just coming in, the drop in permits, the drop in starts, and that'll be an issue. We know that the car market is in a recession, not because there's no demand, but because there's no supply. It's hard for them to get the parts. And at the rate at which interest rates have gone, clearly auto loans are going to be more expensive for individuals, and the willingness of lenders to lend subprime, I think, is going to be diminished. So I think we're looking at a recessionary environment, but for now, I view it more as a growth recession. call it a soft landing, call it a rolling recession. As one sector after another kind of goes through this recessionary environment. Look, we're going to have strong fiscal spending on infrastructure, assuming that they can get the workers, of course. We're going to have, I think, pretty strong capital spending in the energy sector. I know that the energy companies have cut back their capital spending, but the whole sentiment and politics of energy seems to be changing in a direction that might actually allow them to expand their capacity and make money selling oil. Now that everybody realizes that the transition to a clean energy base, whether it be solar or wind or some combination thereof, whatever it is, the clean energy transition is going to take a while. And in the interim, we need to continue to produce more oil and gas. And of course, the geopolitical ramifications make that true as well. Consumers, they've been continuing to spend. Growth rate in consumer durables and other consumption areas of goods is probably going to slow here. They bought a lot of durables over the past couple of years. The services still looks like it's going to grow. Real incomes might actually improve because I think we are going to see some improvement in price inflation relative to wage inflation. Wages tend to be a laggard. And so real wages could actually increase here. And that would also keep the consumer spending. Let's go look at some of the charts here that are relevant to this discussion. So here we go. First and foremost in the morning briefing, I kind of reviewed the fact that everybody's pessimistic, everybody's bearish. And maybe rightly so. I mean, clearly the Fed seems to be on an mission to bring inflation down, even at the risk of causing a recession. So as they raise interest rates on the short end, that continues to drive bond yields higher, though not as fast as short-term rates, because I think there's an increasing perception that if they keep doing this, something will break in the credit system, a financial crisis, causing a credit crunch and causing a recession. Again, it's become more a likely scenario, but I think it's going to play out more as a growth recession. But it doesn't matter what I think. What matters is what consumers think and CEOs think and investors think. And we can see that they are extremely pessimistic. Consumer sentiment bounced up a bit in September from these lows, but we're still at cyclical lows on consumer sentiment. It bounced up because gasoline prices have come down and consumer sentiment's very sensitive to particularly the price of gasoline. I guess it's the one price that you see every single day, whether you're driving or just a passenger. It's right there posted on big signs on top of gasoline stations. Figure 2 shows that the third quarter roundtable CEO confidence is down, and that has a bearing on capital spending. It's not at a level here that's recessionary, but it's going in that direction. So we'll see how that plays out. I think it's going to turn out to be something more like this. I mean, there was sort of a mid-cycle slowdown back in 2016. So we'll see how it plays out. But the reality is confidence of the CEOs is down. Small business owners have been very depressed, and you can see that their optimism index is down quite a bit. It's not as bad as the great financial crisis, but it's the same. It was actually worse, but the same as during the lockdown recession. That's pretty bad, since a lot of small businesses had to close. And then investors' intelligence bull-bear ratio, after rebounding from being under 1 during the sell-off from January 3rd to June 16th, we had this little bounce here, and now we're back under 1. Now, again, from a contrarian perspective, all this pessimism, all this bearishness may very well set the stage for some pretty significant buying opportunities in all sorts of assets. That doesn't mean that they go straight up or that they're not going to be faced with some losses on a short-term basis. But I think on a long-term basis, this is a good opportunity. There are opportunities popping up across the board and many asset markets. We can see here that the equity put call ratio shot up to 1.02. I've been paying more attention to this because my friend Joe Feshbach, who I talk to on a regular basis, he's been a trading strategist. He's traded his own account very effectively. I worked with him at Prudential Securities many years ago, and I kind of view him as a stock market psychiatrist. He's seen it all, and he kind of seen the patterns. He's not your classic technician, so I kind of like the contrarian aspect of his work. And from a contrary perspective, you can see that the put call ratio on Friday really took a shot to the upside. So maybe the 3666 low will hold. Again, doing this on a pre-recorded basis on September 25th. You might see it before the market opens on the 26th. We'll see if 3666 holds on the S&P 500. We went under it on Friday, and then we closed above it. There's nothing particularly magical about it. Maybe there's something a little bit devilish about the 666, but it could certainly fall below that. Question is, where do we go if we don't hold 3,666? Well, there's all kinds of possibilities. And again, I'm no technician, but everybody who's in this market pays some attention to charts. And so this is the S&P 500 versus the 50-day moving average, and versus the 200-day moving average. And you can see that in this rally from June 16th through August 16th, we went through, we went above the 50-day moving average, but we couldn't take out the the 200-day moving average. So that failed, and it's been going down, and then it kind of cut right through the 50-day again. And now I'd say we're about as oversold now as we were back here. I think something like 13% of the S&P 500 companies are above their 200-day moving average, which is pretty much where we were back here. So we'll see how that plays out. We won't have to wait long. We'll find out in the next few days. I'm a little bit bearish here on the notion that we're going to have a lot of Fed officials just yapping away. There's a blackout period prior to FOMC minutes in which they're not allowed to talk. And now, as of Monday, we're just going to have a deluge of these people talking, and they're all going to be yapping away, kind of doing mini-me versions of Jerome Powell's Wednesday press conference. And they'll say that we're on the low end of restrictive. We've got to get more restrictive. We've got to bring inflation down. Inflation is painful for everybody, and it's better to bring it down now than wait, because if we wait, then the ultimate recession that we have to bring inflation down will be worse, yada, yada, yada. So we know where they're going to go with all that. If we do crack below here, you take your own pick here. But one thing to watch out for is all the way down here is around 3,300, which is the high that we made, the record high we made before the pandemic. Before that, I'm sure technicians who know what they're talking about have some other levels to look at here. But I'm a fundamentalist, and I'm not giving up on the growth recession ID. No growth rather than significantly negative growth, more a mid-cycle slowdown. And in that case, I view that the forward earnings are going to be going sideways for a while. So if I'm right about that, what about the PE? Well, you can see, as I mentioned before, the valuation multiple has gotten hit here. And so this is the forward PE. We're actually back down to 15.5. So I think this was like 15 down here. So we're getting pretty close to that level. 15 is widely viewed as being sort of the fair value, but it's also widely viewed as being too high if we're going to have an actual recession. Because if we have an actual recession, then earnings won't go sideways, they'll go south hard. And as the profit margin goes hard and down hard, and as revenues go down hard. And so you just got this double, triple whammy. The profit margin goes down, revenues goes down, the profit margin goes down, so earnings go down. And so the valuation gets clocked because they're all going down. And so all these terrible things happen in bear markets. And I think we've already discounted a lot of it. We're down 23%. There's some talk that, well, I think we'll get to kind of a 30% drop or 29% drop if we go back and find support at the level right before the pandemic started. But this clearly is an issue, and it can change pretty rapidly. As you can see, we went from 15 to 18 on the forward PE, and now we're back down to 15.5. And those swings, a lot of money up and down. Look at the another indicator here on breadth. You can see that how quickly things have changed. This kind of reminds me of watching that 70s show. Actually, I have to admit, I never saw it. I've seen the commercials for it, but I know what it's about. So it's kind of like, I imagine watching the 70s show and then pressing the fast forward. I mean, it's extraordinary how quickly things are evolving here. So you saw how quickly we went from extremely oversold here on June 16th to the August 16th high, where the percent of S&P 500 companies trading above their 50-day moving average had this extraordinary swing. And as I said, that the 200-day moving average is very similar. Going back to the idea that the Fed is already very restrictive and maybe making its second mistake. The first mistake was giving too much weight to unemployment and not focusing enough on inflation. That mistake was first made in August of 2020. Now the mistake that they're making is they're being too restrictive. Look, the dollar is very strong. Quantitative tightening part 2 is restrictive. And now this 3 rate hikes in a row of 75 basis points is very restrictive. And it's clearly having an impact on the housing market. As you can see, the mortgage rate has absolutely soared from around 3% at the beginning of the year to almost 7% now. And some of that, a lot of that's because the 10-year bond yield has soared. But some of that is also because the spread between the mortgage rate and the 10-year bond yield has also soared because of QT2. I mean, traders figure if they're not going to be buying mortgage-backed securities, they're going to be selling them, then you want to get a better spread of the mortgage rate over the 10-year. And this is what the Fed's QT2 looks like on the mortgage-backed securities. They intend to reduce their holdings. Let me move that back up. They intend to reduce their holdings from something like $2.7 trillion down to $1.7 trillion, $1 trillion over basically 2.5 years. And so again, the mortgage market's already discounted, anticipating it, and it's leading to higher mortgage rates, which is depressing home prices and activity, of course. So here you have the new plus existing single-family home sales. You can see that the red line is taking quite a drop. I think it's something like 30%. And the same thing goes for the mortgage applications, which are still falling. And remember, this was still when the bond yield and the mortgage rate came down a bit during July and August, and now we got them both going straight up. And so that's bound to continue to depress mortgage applications. This, by the way, is QT2's impact on the Treasury market. And you can see that the Treasury securities that the Fed holds is slated to go down from 5.7 trillion, let's say, to 4 trillion over the next year and a half. So that's substantial, and may certainly be one of the explanations for why we're seeing the government bond yield going up the way it is. Though I still think that we're seeing some significant flows from overseas coming in and buying U.S. bonds, government bonds. They've been doing that in size for the past 12 months, and I think they're still doing it, as evidenced by the very strong dollar. But there it is. There's the 10-year bond yield. Not a happy looking chart. You can look at it on your own, but this is when Powell addressed us at Jackson Hole and did that pivot. So, I mean, I guess this drop in the bond yield was associated with Powell indicating that they were going to tighten, but sort of a reasonable pace and pause occasionally. But then they completely swung around to this new pivot of full steam ahead, and that's the impact it's had on the government yield. In terms of fiscal and monetary policies, I just want to show you a couple of charts here. I guess there's a lot of concern. There should be a lot of concerns about QT2's impact on the supply of treasuries. But I want you to keep it in perspective of supply and demand for treasuries. On the supply side, the federal deficit has shrunk considerably from over $4 trillion on a 12-month moving basis to something like $1 trillion. So there is less supply. $1 trillion is still a lot of dough, of course, but it's a lot less than $4 trillion. And a lot of that was absorbed because the Fed came in and bought a lot of these treasuries. And now they're cutting it back, and they're going to be cutting back to zero. So they won't be increasing their treasuries on a 12-month basis, yearly change, and they'll actually be reducing it. So again, there are other sources of funds like foreign inflows, like households concluding that if they can get a treasury at 3 to 4%, or a junk bond at 8%, or a muni at 3.5%, AAA, that looks pretty good to them. So just keep that in mind. It's not all doom and gloom because of QT2's impact on the treasuries. This is just another related chart where I'm looking at consolidating the Fed and the Treasury together, just to keep track of what is the amount of supply coming from the government, netting out what the Fed does relative to the federal deficit. Federal deficit shrunk, but the Fed's going to be shrinking its portfolio of treasuries. That's it. Thanks for joining this pre-recorded call. We're not going to do a Q&A because it's pre-recorded. But thanks for joining me. Have a good week, and we're all in this together, and I'll keep you posted with QuickTakes and how things look to us, and these web chats and the morning briefing and weekly briefing, of course. Thank you.